Dear viewers, welcome to this week's episode of Expert Speaks. Quarter 2 of financial year 2023-24 is behind us. It's time to take stock of the situation, find out what happened in the last 3 months in the Indian economy, where are the threats, where are the opportunities. I will speak to ACE Fund Manager Harini Dedhia in this episode. This is NRI Money Clinic for you, and I'm Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, it's time to look at what happened in the Indian economy. Quarter 2 is gone behind, and let's look at where is the progress, where are the roadblocks, where are the opportunities, and where are the threats. Expert of the week, Harini Dedhia, is going to brief you on all these aspects today. Harini Dedhia is not somebody who is new on this channel. You see her very regularly. For those of you who do not know who Harini Dedhia are, if you are watching this channel for the first time, let me give a brief introduction to her. She is Head of Research and a Fund Manager at Tamohara Investment Managers. She started her career way back in New York. She is a graduate of BA Honors with specialization in economics, political science, and advanced mathematical models from New York University. She started her career from New York working for a hedge fund. Then she moved to India, worked with Ghalla Bansali stockbrokers. She was managing the truffle investments. Currently, she is looking after the Quant PMS under Tamohara Wealth Managers. The Quant PMS managed by her has got very good rating both by CRISIL as well as the PMS Bazaar. It's time to hand over to Harini for her commentary on the quarter which is gone by. It's over to you, Harini.
Thank you, Dr. Bhatt, for having me. And I'm glad to be back with another quarter of winners and losers across the market. And just to try and make sense of the quarter that's gone by, what has happened and what we see the initial strands of that are in play today and that we can probably see materialize over the next few months or so. So diving straight into the outlook for the market and trying to make sense of what has happened in the quarter now. The last time we spoke to you on this particular topic was around July, and it's been 3 months since. So it makes sense to take stock of what has happened. Markets since the last time we spoke haven't really done much. We have seen, especially in the US equity markets, have been more or less flat. Even in India, it seems like the last 3 months have been filled with activity. You've seen a lot of small caps, mid caps. Some of them have seen crazy amount of gains. But things have quietened down in the last 15 days or a month or so. But in the larger companies, we've not seen too much happening, right? So the last time we spoke to you all, Nifty was at 19,200. Today it is at 19,700 odd. So there's not significant amount of action that has taken place in the larger companies in India, so to speak. And action in the smaller companies has also quietened down. And the reason for that is also already there on this table. You're seeing INR consistently weakening. The FII flows that we spoke about last quarter, we've seen in the month of September, this flows have sort of reversed and we've seen a lot of profit booking. Part of it could be because of the rupee. Part of it is also because the US 10-year GSEC bond yield has just spiked significantly, right? We are seeing it now at levels that were seen in 2005-06 in the past. So we are at 4.5, inching towards 4.6 as we speak. And that is probably a big worry area that we would have today, because the spikes that we've seen in the bond yields suggest that there is some pain that we're about to see in the financial markets. What is really surprising is that all of us probably would have thought that we would see some sort of event happen in China. We've all heard of the defaults that, in the real estate sector over there. However, the Chinese treasuries or the corporate bonds have just not seen this kind of spike in the yields that we've seen in the US. So that has been a very big surprise. But from an India perspective, I think whenever we see the US 10-year spike, FIIs obviously tend to reduce their equity allocations at that point of time. And that is what we're seeing along with some amount of profit booking this time around in the month of September. We are also seeing crude inching upward. So we're now seeing crude, comfortably, the WTI comfortably above $90 a barrel and the Brent a little bit higher than that. So across the board, what one would advise would be that, if you are already invested in the Indian equity markets, you would probably stay the course because, again, the larger companies have not seen too much movement. They've not seen too much disruption. From October 2021 levels, there's hardly been a 3-4% CAGR that has come into the larger companies and the Nifty 50 index, so to speak. And earnings have definitely compounded far north of that. So in the larger companies, you're getting valuations at significantly more reasonable level. But in the smaller companies in India, yes, there could be a better entry point that can come along now. So that is something that one should be aware of. Now, while we can all, throw caution to the wind and, be like, okay, the market has rallied so and so, and it is time for, correction and this and that, but the market had just cause to rally as well, right? So if you see the EBITDA margin for BSE 500 companies, right? These are the top 500 companies of India. So we have taken a broader spectrum. We've moved beyond the large cap companies and included the mid and small cap as well. The margins year on year have gone from 13.5% to 16.5%, right? So even if my top line has grown at a high single digit level, right, 8 to 10% or 8 to 9%, this margin expansion of 300 bips is significant. And we believe that in Q2, this fact itself will continue and we will see a lot more resilience in the earnings. So we think that even if there is a price correction, it would be a shallow one. We are more of the opinion that we're likely to see a time correction in the broader markets, simply because my earnings growth is going to look very, very sanguine. So second quarter FY23, we did a 12% margin. Even if we were to match Q1 margins of 16.5%, there's going to be a significant delta over the second quarter numbers for the broader markets in general. So the profit cycle has continued its uptrend as we discussed on the previous slide as well. This is probably on its way to continue compounding. And why we say it's on its way to continue compounding is that this profit margin, we're still not near the high. We're close to the highs, but we're not near the highs. The high was at about 7% profit to GDP ratio. We're at 4.75% right now. So we are inching towards the previous highs. But the most important thing is that this time around, India Inc.'s balance sheet is stronger than it has ever been before. We are sitting at the 21st century low of debt to equity for India Inc. So our debt to equity for BSE 500 today, X of banking stocks, because they obviously work on leverage, is at 0.18, 0.19. So we are comfortably deleveraged right now, so to speak, and we would see companies have a lot of ability to reinvest their profits and continue on this path, at least for the medium term, so to speak. So coming back to the question that's there on everybody's mind, the markets have rallied a lot. Should we really invest right now? Like we discussed, I think small and mid caps, you could find a better entry point. Larger companies, we've seen a significant time correction from October 21 to right now. So even if we see the Nifty 50 forward P is at 19.5 times odd, that is nowhere near the peak levels of 24-25 that we've seen typically when the Nifty tops out, or when we enter into a global financial crisis or an overheating of the market. Either of the three outcomes. Some of the other ratios that we look at as well, market cap to GDP, it is higher than where we would prefer it. The ideal metric for that would be about 100% or 102% odd. But it is nowhere near the point where we see markets making an exuberant top, right? So it is a little bit heated, but nowhere near the exuberant top. And a lot of this market cap to GDP inflation, honestly, has happened in the smaller and the mid-cap companies, right? If you go to see in India's market cap today, almost a trillion and a half dollars of market cap has given you zero returns. You have your HDFC Bank, Kotak, Reliance, HUL, Nestle, the IT companies in the last 2 years collectively put together, all of these have given you a zero return, right? And these are some of the stalwarts of the Indian market. So in India, that scenario is peculiar. In the US, we have top 7 companies performing and the rest 493 languishing behind. In India, the top 7 are not performing and the rest of the 493 are having a gala time. So to that extent, we would want to incrementally allocate ourselves more towards the top 7 who would be far more resilient, even if something was to come out of this US GSEC spike. But in general, just from a bottoms-up perspective, their earnings are going to be far more resilient and their valuations are 25% lower almost compared to where they were in October 21, because they've given zero returns while their earnings have compounded at 12-13% odd. Right. So this is where we are at on the valuation. It's a mixed bag. On the cyclically adjusted PE basis, we do look expensive. But Nifty forward PE or market cap to GDP, we're not in the exuberant zone at all. So we always look at this chart in every quarterly video that we put out. This is the earnings that we're hoping to see for FY24 and FY25 for the Nifty 50 companies. What you would see is the 24 earnings seem very, very high in terms of percentage growth. The reason for that, as we discussed, is not sales growth alone. A lot of it is coming from margin growth. So we've seen earning growth dip from 29% to 14% in FY23. And that is sort of, getting adjusted and corrected for, where we're seeing decent earnings growth coming in because of margin expansion as supply chain issues around the world have settled down. My cost of goods inflation has settled down as well. So a lot of companies are seeing their gross margins go back to previously normal levels. So coming to the sectors, last time we discussed 3 sectors, pharma, IT, and consumer. Since we discussed them, these sectors have all outperformed Nifty 50 index, right? So pharma has done the most amount of outperformance at 16%. At 13%, you have Nifty IT companies, and at 9.5%, you have Nifty consumer companies. The anomaly in this is actually Nifty Pharma, because here the earnings growth have finally come through. We commented on that in the previous video as well, where we talked about how pharma has already delivered a 24% growth in operating profits, and that performance has been matched up with a sequential 15% growth in profits as well this year. So in the last 3 quarters, we've seen pharma sector consistently outperform on earnings basis, and that has finally been rewarded by the markets as well. Nifty IT and consumer, we've still not seen the earnings performance come through, but as valuations are corrected, we were expecting some amount of bottoming out and some amount of incremental allocation coming here as well. That seems to have played out, but earnings over here are still not as sanguine as they are in the pharma sector. But I think, as we've discussed in the past, that performance in the market is a factor of valuations or flows, the derivative of why we look at valuations or anything that could be considered a technical indicator is just to understand the flows of the market. And in the other factor is obviously earnings. So the flows and the valuation part is something that played in favor of IT and consumer, whereas the earnings really played in Nifty Pharma's favor. So going forward to what we think could be happening at a sectoral level now, we would see incrementally that the stronger banks, that the larger private banks, which have especially given no returns for the last 2 years, to do incrementally better. This is because a large part of the last chunk of growth, of credit growth that we've seen in banks over the last quarter or so has come from unsecured lending. And this is the riskier part of lending that has been done by the PSUs and some of the smaller private banks. And we believe that the larger private banks with a greater framework for risk management should do better. We are positive on the banking space given valuations, because the valuations are at a 10-year low, especially for HDFC and Kotak Bank. But otherwise as well, they're not too beyond the mean level for this sector. But we believe that the best is behind for the weaker banks, banks that do not have great risk management systems. We will see NIMS compression. We will see higher credit costs creep up over there. And the unsecured lending growth, which is the riskier growth that has come in the last quarter, within a year or so, we will see pain coming through from that book as well. So in banks, we would recommend a shift to the stronger, larger private banks at this point of time. Within autos, we have started paring down our overweight position, while PVs have continued to show resilience and volume, and so have commercial vehicles. We believe that it's very difficult to achieve more than single-digit volume growth from this point of time. We believe that margins have also normalized. As you've seen, gross margins have come back to a normal level now. So the incremental earnings cannot surprise you too much in a positive manner. And a lot of it is already in the price. These companies are all trading at their historic high valuations, despite all the disruption that is being faced by the sector. So auto OEMs, definitely we would like to pare down our exposure. We would still prefer some select auto ancillary where there might be import substitution play happening, or even a China plus one export theme playing out. But on the whole, we would be paring down our exposure to this sector. Within pharma, we are expecting the trend to sustain. As you remember from the previous slide, pharma is the one sector where the performance of the stocks has been predated by the performance of the earnings of the company. So we believe that this run-up can sustain. We're not expecting too much of a price correction on this front. And we believe that US business can actually get re-rated for a lot of these generic Indian companies, because pricing is far more resilient. We're seeing a lot many more approvals come through from US FDA for their products now. So we believe that that piece of the business that was looking like a drain on the return ratios of these companies could actually start looking incrementally better for the medium term to investors. Within the consumer space, I think the concerns that are there around rural would remain because of the monsoons being very, very erratic this time around. We had a very, very wet July and then a very dry August. So there has been some amount of disruption that has happened on the rural income level. We would have better comfort on commenting on this after the rains and the monsoon seasons have finally gotten over, to understand really what is the deficit level, what is the crop acreage level and crop yield expected to be. But our understanding is that staples would do well in the interim, simply because construction workers under the Manrega scheme, etc., have been given a significant wage hike this time around. We've seen a lot of MSP hikes for a lot of select crops that have come in this time around as well. And in general, moving into an election year, we do see a little more comfort over rural incomes coming from external perspectives, even though internally, structurally, it may not be as great as we would have hoped for it to be. We believe that staples could do well in the interim. But for us, the most structural way to play the Indian consumer is luxury. One very interesting thing that has happened in India, and it's very difficult to believe this, seeing the way our population is growing currently, is that we have breached the level of fertility below which it is difficult to maintain the population number, right? The fertility level at which the population number gets maintained is about 2.1, right? So 2 parents have 2 kids. And then 5% is adjusting for the fact that some people don't have kids, some people unfortunately pass away early on, or whatever it is. But this is typically the level at which the population of a country can hold stable. India's fertility rate has now fallen below 2%. This has happened in Japan in the 1970s. This happened in China in the 1990s. So while 20 years later or 30 years later, we will see our population coming off, what is pertinent today is the fact that if people are having fewer kids, they are going to consume and save and invest more for themselves. And we've seen that happen in Japan when this phenomena occurred in the 70s, and in China when this phenomena occurred in the 90s. So the next 20 years is absolutely the era of consuming and consuming for ourselves, right? Indian parents so far have been very, very selfless in the way they've consumed. And I think we're going to see a lot more self-consumption and a lot more self-indulgence come into the Indian consumer psyche going forward. So luxury consumption, we believe, is a structural story that will keep playing out over the next decade or so. But apart from that, we do see that the consumer space in general will be resilient for the time being. So that's it from our end on the scorecard for this particular quarter that's gone by and our expectations for what is to come ahead. If I were to summarize it, I would recommend incremental Indian equity allocations to be more skewed towards the larger companies, as we have discussed. If you are looking to invest sectorally within banks, we would prefer the larger private banks. We would advise also to look at pharma and consumer space, but do stay away from the pockets of irrational exuberance that we've seen in the capital goods segment that we've discussed in the last call as well, but also from some pockets of small and mid-cap where we've seen a lot of run-up and there could be some amount of price correction coming in as well. Thank you.
Thank you, Harini, for that commentary on the quarter which has gone by. I'm very sure my audience will take cues from the points you have brought to their notice and position themselves accordingly. For those of you who want to invest in the Indian stock market or who wants to invest to reach your life goals, the services of NRI Money Clinic are available to you. We have a team of experts on the ground who can take care of any of the things that you might need. If you have an intention to invest in India, all that you have to do is reach to us through a WhatsApp message. Our numbers are given here in the description box. I have also provided a link there. Just click on the link. It will take you to your WhatsApp and send us that message now. And my team of experts are ever ready to help you with this. And before I conclude, let me request you to subscribe for the channel if you have not done the subscription even till now. Please press the bell icon to get the notifications. Do not forget to share these videos with your near and dear ones, friends and relatives. Thank you very much for watching this episode of Expert Speaks on NRI Money Clinic. I shall be back with you with yet another expert, with yet another topic next Tuesday. Till then, stay safe. Jai Bharat.
Press the bell icon for more details and subscribe our channel.